Hello and welcome to the KE Report. I'm your host, Shad Markwitz, and I'm speaking today with Kyle Floyd, CEO and Chairman of Vox Royalty Corp., traded on the TSX under the ticker VOXR, and on the NASDAQ markets in the US under the ticker VOXR, same ticker. Kyle, it's great to have you on the show to get an update, especially when you've got exciting news out like you just put out yesterday, talking about record revenues, record results in 2023. So as we look at last year, I won't steal your thunder, but there's a lot of things that you have on the go as a company and a lot of records. Give us an update on a quick snapshot on the financial health of Vox.
Well, thanks, Chad. It's always a pleasure to be on the program with you. And yeah, it was a really exciting 2023 for us. Excited to press release the results that we announced yesterday evening after the close. Really the big headline items are, and I would even go a little bit farther down the income statement or cash flow statement. We're excited about the per share growth in cash flow. That's what this company's always been about. That's what we believe investors ultimately, that's how investors are rewarded. And that's ultimately what dictates the valuation of businesses. And so we don't believe a royalty company should be any different. And when you look at the results that we announced, what I think stands out and what I think when you think about Vox, what we're focused on is cash flow per share growth and operational cash flow. And that was up over 157% from 2022 to 2023. We doubled cash flow per share from 7 cents to 15 cents. And that's a metric that we're really focused on. That's what our business is geared to accomplish for our shareholders. And so we're proud of that result, but we're laser focused on increasing those metrics significantly. And we have the competitive advantage to continue doing that in a highly accretive way. So very excited about the results. Also noteworthy is we increased our dividend again to 9.1%. It was a 9.1% increase. That's the second consecutive time that we've been able to increase our dividend since inauguration. Very pleased with that. And that also goes back to what we've talked about historically. When we inaugurated a dividend, we said, this is something, our dividend is something that we believe will be sustainable and capable of growing. And we're demonstrating that now year in and year out and quarter in and quarter out. And we just have a very, very strong business that's been designed from the bottom up and from founding to generate these types of results from investors. We're generating the highest return on invested capital in the industry. And that's allowing us to accomplish these financial gains for our shareholders. And ultimately, I believe that's going to be represented in the valuation of the business, which at this point I would say is not, but we're working to make that reflected and ultimately continue to produce those returns for shareholders.
Well, Kyle, let's dig into that idea a little bit more. Let's talk about the return on invested capital first. What you mean there is basically when you're spending a dollar to generate some kind of a value accretive transaction for the company, you've spent less and generated more income than many of your peers. I think that's a distinguishing point for Vox. So maybe unpack that a little further for investors.
Yeah, to put this in context, now we can talk about 2023. I've been wanting to talk about it for a while, but we can't until obviously earnings come out. We did about 12.3 million top line. We put a little over $50 million to work buying third-party mining royalties. That has resulted in, if you just look at this year's revenue, that's approximately a 25% return on invested capital. That's just current year. That doesn't take into account what we're going to continue to accomplish in terms of revenue and cash flow growth over a long duration. The rest of the industry is targeting between 2% to maybe 5% at the high end. And so we're generating returns that are exceeding the rest of our peers and the industry and consistently able to do that. Another interesting data point for us is we've had 9 assets go into production. We expect to be paid back all 9 of those assets by the end of next year or early 2026. And most we've already been paid back. So we're finding royalties over great projects. Our technical team is doing the right work. We're valuing assets appropriately. And that is what is ultimately yielding the financial results for our shareholders. And that doesn't take into account all the optionality that we have within the portfolio. There's approximately 100 million gold equivalent ounces covered under north of 1% royalty on average. So the optionality is also there in our portfolio, but we're also able to accomplish very meaningful results for our investors in the here and now.
Well, I want to get into optionality in a little while, but I want to circle back to something you just talked about and just how quickly you're basically getting paid back on some of the third-party royalties you've purchased. When we look at the royalty sector as a whole, a lot of companies have bought royalties that's going to take them a decade, maybe even longer, to even break even on them. And maybe speak to how royalty companies are being valued in the sector, but also why it's so important to get a quick payback on some of these.
Yeah, look, it comes down to buying assets at reasonable valuations and having an advantage in doing so. And I'll tell you, for the last 10 years, we've been steeping that ability to go out and find really interesting royalties over great projects at fair valuations. And so that's easier said than done. It's taken a lot of investment, a lot of time, patience, and building to be able to accomplish that with a systematic, repeatable function that we have. And so you're right. It is, there are a lot of royalty companies that when they're generating, let's call it one, possibly negative, maybe 5% returns, you're talking about very, very long payback cycles with a lot of risk in the interim. So I don't think the risk is priced into how a lot of royalty companies are valuing royalties. And notwithstanding that, the market is continuing to give a lot of our peers very favorable valuations, which, we certainly don't begrudge. We just believe that we should ultimately trade at a higher valuation based on the value that we're able to create. But, on average, analysts have us trading at about 0.6 times price to NAV. And a lot of the industry is trading north of 1 times or even higher. And obviously, you have the majors trading around 2 times. And then also from a cash flow basis, we're trading at the lowest in our peer group. So we believe that, ultimately the market's going to reward and our valuation is going to reflect the value that's been created and our competitive advantage that's very long-term and durable in terms of continuing to create that value for our shareholders.
Yeah, Kyle, definitely some room to close the gap there as far as some of those peer valuations and just in general in the sector. Let's talk a little bit about the royalty model in general, though. I think one of the reasons that many of the peers in the royalty space are getting such high valuations, and I'm sure a higher valuation is coming to Vox eventually, is due to the optionality, really twofold. One is the discovery optionality, the ability for some of the royalties you have for the operators to make new discoveries and expand resources. And the other thing is something we were talking about before the call, and I think this is very underappreciated in the industry, and that is the production optionality. If there's a rising gold price, and if companies can take resources and move them into reserves and extend mine life or actually grow mine life as a result. So maybe speak to the optionality in the royalty business model.
Yeah, and Chad, it's a really good point, and I think it can be a little bit misunderstood or not fully appreciated in the royalty context. But when you have a rising metal price environment like we have right now, and we've seen that across, the multitude of commodities we have in the portfolio, obviously very gold weighted for us, so we'll focus on that for right now. But when you have this rising gold price environment, what you see is a lot of times operators lower the cutoff grade. And so they might lower the cutoff grade by 10, 15, 20% to keep up with metal price. Now, the cost to produce that ton or that ounce also increases. But for the royalty company, it does a couple really productive things and it's compounding in the royalty company's favor. So it's a delayed reaction to metal price when the royalty companies start realizing these compounded returns. And what's happening is that 20% reduction in cutoff grade could increase the reserve base by 50%, 60%, sometimes even more. And so that's all pure gain to the royalty company because they're not paying anything to get those tons or ounces out of the ground and produced. And then that's also compounded by the higher metal price in and of itself. So it's this compounding function that almost goes exponential in the favor of royalty companies. And that's why royalty companies have outperformed over the long term versus operating mining companies on average, I believe is because, or one of the primary reasons is because of that function that works so favorably for good royalty companies that have royalties over the right kind of project. So it's something that I think your viewership and your listeners should key in on, is that this compounding function is probably not what is well understood as it should be, and it's very profoundly positive for royalty companies. So when you get this type of rising metal price environment, it's a delayed reaction for royalty companies, but it's coming.
Well, and I think that highlights another good point about the growth trajectory. A lot of people, Kyle, are in a drill play for a couple of weeks to see if they hit or if they don't hit. They may be in development companies for, let's just say, a year or two as they hit that pathway into production. Some people will stick with producers for a little longer, but really with royalty companies, it's a little bit of a delayed gratification, but over time, not just that production optionality you just outlined, but also, as we mentioned, the exploration, the discovery optionality to keep finding new deposits or new areas of a deposit or something at depth or maybe an open pit, a satellite pit. So there's all these areas that can over time continue to create value long after you've bought the royalty. So maybe speak to the delayed gratification side of valuing a royalty company.
Yeah, it tends to not be immediate. Certainly, good revenue-based royalties will see some increase or decrease based on what's happening with the underlying metal price. But it's this delayed compounding effect that's really, really profound. That is why I believe royalties are the single best asset in the commodity sector. You are getting a compounding effect with no incremental dollars in. So if we bought a royalty for say $1 million a year and it's generating revenue for us of $1 million a year, when they decrease the cutoff grade, they increase the reserves by, let's say it's 50%, and then that's compounded by a higher metal price, all of a sudden your rate of return is going through the roof. And we are not subject to providing any of the capital that's necessitated to realize the increase in production. And so it's essentially an exponential equation that works in the favor of royalty companies, but it doesn't happen automatically. Metal price, gold, let's say gold's up 15, 18% over the last month or so. It's a delayed effect from there. And again, I think most of the investing marketplace doesn't fully appreciate that compounding effect that's in favor of the royalty companies. And you'll see that play out over the coming quarters and years if this metal price sustains itself.
Well, and one more area that we should highlight as far as kind of the delayed gratification is usually a royalty company is valued and its net asset value is determined based on what's in production right now, what's generating revenues and cash flows right now. But as most people know, there's a bunch of pipeline projects that are not in production yet, but can eventually move there. So maybe just remind folks, how many royalties do you have overall, and any of the ones in development that you see moving down the pipeline that you're excited about in the years to come?
Yeah, so actually it's 8 assets that we have that are in production, or we have a royalty over tenure that these assets are in production on. 6 cash flowing right now. And of those, we have 3 of those are from producing gold operations. And so, we're in good shape. Our NAV is predominantly gold. That's the highest weighting in our portfolio. And, as you noted, what we've been really cherry picking is simple geology with exploration potential. So all of the assets that we have in production right now are open pit. And the next 2 that we expect to come online are also open pits. And so we've been able to cherry pick really good geology, simple metallurgy, simple processing at very high margin operations that also have exploration potential. And so in a higher metal price environment, you not only have the reserve grade possibly, or sorry, the cutoff grade possibly dipping, which is hugely productive for us, but you also have that exploration potential, or the fact that existing exploration targets and resources now are much more kind of in target line to bring into a mine plan than maybe they were at a lower metal price. So you see there's a lot of incentivization for mining companies to go explore further, and then also to bring those late stage exploration projects into a mine plan at some stage now with a higher metal price. So it's not just that existing resources are converted to reserves. It's the fact that you now have other deposits that can become, very significantly economic, that at a lower metal price weren't included in any mine plan at all. So a lot of benefits in a higher metal price. Again, it doesn't happen overnight, but the results are pretty profound.
Well, and Kyle, just for people that may be looking at Vox for the very first time, remind them of the mix of metals you do have. You said it's a lot weighted to the precious metals, but I know there's some other commodities in the mix. And then just remind people of the overall portfolio of royalties the company holds.
Yeah, absolutely. So we are the second largest holder of hard rock mining royalties in Australia. And we believe that owning mining royalties in Australia is the best jurisdiction to be. There's a lot of reasons for that. Great geology, great people, great rule of law, great infrastructure, and ultimately a jurisdiction that we think is the best place to have royalties. So we're the second largest holder after Franco-Nevada in terms of mining royalties in Australia. And so when you look at our commodity weighting, a lot of it resembles, frankly, what the geology is of Australia. It's a lot of gold, it's a lot of iron ore, and it's also, a good mixture of base and industrial metals, copper, zinc, commodities like that as well. So we're very, very heavy gold. Again, the heaviest weighting in terms of NAV and number of producing assets. There's some really great iron ore assets within our portfolio, and iron ore has been, in terms of commodity prices, an exceptional outlier in our favor. And then look, we've got some good copper and we've got some good base metals in our portfolio as well. So we're really pleased with the commodity weighting. I should note that we're largely agnostic. We're value focused. I think we're the exception in the royalty space, and that value is the North Star for us. We look at per share returns and per share metrics, I think more than probably any other royalty company. And you see that manifesting in terms of the results that we're generating. But we're looking for value. It just so happens that we found the deepest value in gold in Australia and Western Australia more specifically. So we're a value focused royalty company, and we're growing in all the right ways and focused on delivering accretive growth for our shareholders.
Well, Kyle, we'll wrap it up there for today. I'm sure we'll be talking again down the road, though, just to get some partner updates on some of the other projects. But a very impressive close to 2023 as far as revenues, cash flows, all of the different metrics you outlined. A nice pipeline of growth on tap with some of those other assets getting near production. And in a rising gold price environment and rising metals price environment, some optionality just to rising metals prices themselves. Kyle, it's always great having you on the show. And if people want to follow along with the news at Vox, definitely click on the link below this interview. It'll take you over to the Vox Royalty website. And looking forward to our next conversation, Kyle.
Likewise, Shad. Always appreciate it. Thank you.